Look at your last 3 months. How many ended at 0? How many ended in the red? Personal finance basics are not glamorous, but they are the floor every investing return is built on, and the floor is what most beginners try to skip. 3 moves lay the floor. They are not the ones the personal finance algorithm is selling. They are quieter. They are older. They are arithmetic. And the next 10 minutes will walk you through each one, with a real worked example for each. Quick, honest question. When you look back at the last 3 months of your bank account, how many of them ended at 0? Or worse, in the red? You don't have to say it out loud, just answer in your head. That number is your starting line. The foundation begins from exactly there, not from where the algorithm wishes you were. Here is the thing nobody puts at the start of an investing video. No combination of brilliant fund picks fixes a household that spends every dollar it earns. No magic stock saves a balance being drained by 21% credit card interest. The compounding code only works when there is something to compound. And the something is not your portfolio. It is the gap between what you earn and what you spend, routed before you can spend it. That gap is the foundation. The investing comes after. Most personal finance content gets this backwards. It teaches the building before the floor. So people buy index funds on top of credit card debt, or panic pick stocks while their checking runs to 0 every payday. The arithmetic does not survive that order. None of this is investment advice. It is education. Always do your own research. If this is the first time someone has told you the floor matters more than the building, hit subscribe. We move calm and patient on this channel. And stay through the third move. Most beginners get the third one backwards, and it costs them more than the first 2 combined. The framework is called the money foundation. 3 moves, in a fixed order. Lowest cost first, then up the cost ladder. Move 1, spend less than you earn. Move 2, kill the bad debt. Move 3, pay yourself first. That is the whole foundation. No optimization. No tax arbitrage cleverness. No alpha. Just 3 quiet moves done in order. The reason the order matters is mathematical, not moral. Each move multiplies the one before it. Doing them out of order, say, opening a brokerage account before you have a savings rate, is the most common reason a calm investor is not yet calm. Move 1. Spend less than you earn. J.L. Collins writes in The Simple Path to Wealth, the Harriman House Revised Edition published in 2025, that the foundation rule is to spend less than you earn, invest the difference, and avoid debt. 3 sentences. Decades of compounding. It sounds obvious until you do the arithmetic on what skipping it costs. Let me make the math concrete. 2 households. Same take-home pay, $70,000 a year, after tax. Household A spends $70,000. Household B spends $59,500. Household A's annual surplus is 0. Household B's annual surplus is $10,500, a savings rate of 15%. Project both households forward 30 years. Household A has 0 invested principal, regardless of what the market does, because there was nothing to invest. Household B, depositing $10,500 into a broad index every year at a long-run nominal return in the 7% range, ends with roughly $1 million. The market did not pick favorites between A and B. The savings rate did. Same income, same job, same paycheck. One household ends with $1 million foundation. The other ends with 30 years of memories of spending the whole paycheck. And here is what stings. Household A could have been the world's best stock picker, could have doubled the index every year, and still ended in 0. Because 0 times anything is 0. The National Bureau of Economic Research Working Paper, number 32847, published in 2024, decomposed U.S. household wealth growth and found that variation in the saving rate explains far more variation in long-run wealth than variation in investment return. Read that twice. The savings rate matters more than the return. The arithmetic above is why. The cheapest fix is also the simplest. Find one fixed expense, one, that you can lower this month. A subscription. A grocery line. A car insurance shop. Move 10% of the difference into a separate savings account labeled, "Do not touch." That is your first surplus. The foundation has its first dollar. Move 1 is in motion. Move 2. Kill the bad debt. Andrew Tobias writes in The Only Investment Guide You'll Ever Need, the Houghton Mifflin Harcourt, 2022 Revised Edition, that paying off your credit cards is the highest guaranteed return investment most people never make. That is not a metaphor. It is arithmetic. Here is the math, with numbers. The Federal Reserve's G.19 Consumer Credit Release for May 2025 reported the average U.S. credit card APR on accounts assessed interest above 21%. Above 21. Carry a $5,000 balance at 21% for 1 year, and annualized cost is roughly $1,050. Paid forever, growing as it compounds against you. Now compare that to investing. Take the same $5,000 and put it in a broad index fund. At a long-run nominal return in the 7% range, the expected first-year earnings on that position are about $350. $350 earned by the index. $1,050 taken by the credit card. The credit card's loss is 3 times the index's gain. That is the inversion. While the bad debt is alive, every dollar you put toward investing is fighting a 3-to-1 headwind in the wrong direction. The math is unambiguous. Paying off the card is the highest guaranteed return investment most people never make, because they think investing means a brokerage account, not a payment to Capital One. Tobias has been writing this since the original edition of his book in 1978. The latest revision keeps the line because the math hasn't changed in 50 years, and won't change in the next 50. 21% will always beat 7%. There is no clever investing trick that fixes that arithmetic. The only move that fixes it is removing the 21% line entirely. The action shape is mechanical. List the balance. List the rate. Highest rate first. Send everything you can, on top of the minimum, to the highest rate until it is 0. Then move down the list. Some people call this the avalanche. The math is what makes it work, not the name. Move 2 is in motion the moment the highest rate goes to 0. Move 3. Pay yourself first. John Bogle wrote in The Little Book of Common Sense Investing, Wiley's 2017 10th Anniversary Edition, that, quote, "In investing, you get what you don't pay for," end quote. Auto-routing is the closest thing to free money the foundation has, because it works without willpower. And willpower is the most expensive resource on the foundation. It runs out exactly when it is most needed: payday, end of month, the holiday spend window. Auto-routing never runs out. Here is the math, with a real worker. A worker earning $60,000 a year enrolls in their employer's 401k. 5% contribution from the worker. Employer match, dollar for dollar up to 4%. Standard plan. Nothing exotic. The worker's 5% is $3,000 a year of their own money. The employer match adds another $2,400. Total annual contribution into the 401k, $5,400. On a personal outlay of $3,000. That is an immediate 80% return on the personal outlay, before the market does anything. No stock pick has ever given anyone an 80% return on day one. The match does, every payday, while the worker is at lunch. Skipping the match means leaving the $2,400 on the floor of the Human Resources Office every year. Compounded over 30 years at a long-run nominal 7%, that $2,400 per year of free money becomes roughly $250,000 at retirement. Not your savings, just the match. That is the cost of skipping move 3. And here is what makes the move durable. Vanguard's How America Saves 2025 report found that auto-enrollment lifts 401k participation from around 51% to around 94%. The design beats the willpower 9 times out of 10. People who would never have signed up by themselves participate at 94% the moment the default flips. The discipline is in the architecture, not the human. The action shape is one decision, one time. Set the auto deposit. Capture the match in full. Raise the contribution 1% every birthday. Move 3 runs itself. You don't get rich on your first stock. You get free on your first foundation. That is the line worth keeping. Move 1 bought you a surplus. Move 2 killed the bad debt eating it. Move 3 put the surplus on autopilot before you could spend it. 3 moves. None of them required a brokerage account. None of them required a market view. None of them required willpower beyond one good evening at the kitchen table. If you have been telling yourself you can't invest because you don't have enough money, hear this clearly. The barrier was never the brokerage. The barrier was the foundation underneath. Build the foundation, and the brokerage account fills itself. The investing comes later. The freedom comes from the floor. That is the money foundation. 3 moves. In order. Lowest cost first. Move 1. Spend less than you earn, the floor every investing return stands on. Without it, the rest is theater. Move 2. Kill the bad debt, the highest guaranteed return investment most people never make. While it is alive, every dollar you invest is fighting a headwind. Move 3. Pay yourself first, the auto route that beats willpower 9 times out of 10. Once it is on, the foundation runs without you. 3 moves. In order. Lowest cost first. That is the whole foundation. The investing comes after. Here is the one thing to do in the next 24 hours. Open your bank app. Write 3 numbers. Number 1, your last 12 months of income, after tax. Number 2, your last 12 months of spending, all of it. Subtract them. That is your annual surplus, or your annual shortfall. Number 3, the dollar amount of every revolving balance you carry. Credit cards, store cards, anything above 10% April. List them. Highest rate, first. 3 numbers. 1 page. Tonight, before sleep. You don't need a spreadsheet. You don't need an app. Most people skip this because they are afraid of what the numbers will say. The fear of looking is more expensive than the looking. The numbers are already true. Writing them down just makes them visible, and visible is the first thing that becomes fixable. If this gave you a measurement you can take tonight, hit like. It tells the algorithm a calm investor video earned a calm investor viewer. Share it with the friend who has been investing without a foundation under it, the one with the brokerage app and the credit card balance, who keeps wondering why the math isn't working. They will thank you in 5 years, even if they don't say it now. And subscribe for the Calm Investor Playbook that turns volatility into compounding. We do this every week. Quiet, patient, arithmetic, the way wealth is actually built. The market does not reward the loud. It rewards the steady. Calm investors. Build wealth with patience, not panic.